All right, I'm going to simplify location into two parts.
Thank God.
One is areas that have a proven track record of performance. What that means is we're buying into a location where we're not having to guess if it will go up or down. We're going to assume, based on the historical performance, that if demand and supply stays relatively constant, that location will continue to perform at a similar rate as what it previously has done. Mm-hmm. Now, if we think about this logically, if we look at the marketplace like the eastern suburbs, all the land has been built up on. There's no new land. Supply is limited. There's only a certain number of properties that sell per year in certain suburbs, and there is a large amount of demand from people that want to live there. Mm-hmm. That demand won't change lower. It'll continue to stay strong, if not higher, because everyone wants things like access to the good schools, lifestyle drivers, access to the CBDs and transport, etc. Yeah. We follow that principle in all when we're tracking historical performance. So two ways you can look at location. One is track the historical performance that has proven track record of that it's had success. Number two is we speculate a location will perform in the future. It may or may not have performed in the past, but we're going to assume based on changes to supply and demand. For example, a new development's happening. A developer's subdivided a big block of land. They're doing a new estate. For example, in Sydney, we've got areas like Box Hill, Marsden Park, Schofields. Developer has created supply. And because there's created supply, demand will be, we're going to assume that people will want to buy in those locations. Now, the challenge with hotspotting is that we don't know if demand will match supply. With new estates, developers can control supply whereby they'll only release a certain number of new builds at a certain point in time to control supply so that there's enough demand to match that. But there could be regional locations or mining towns or places where we can't control supply. For example, land has already been built up on. But where hotspotting can work well is in areas that are going through gentrification. So a location that wasn't very affluent or strong in growth may soon become strong in growth because of things like the Olympics is coming in. Yeah. Or could be that the neighboring suburbs is becoming unaffordable and it's having spillover into that property in that region. So we can forecast the location to go up in value if we have an understanding of what influences demand. So demand is people willing and able to pay for property. What influences that? Again, access to schools, lifestyle drivers, transport, amenities, CBDs. Also, what influences demand is if we're priced out of the location we want to be in, but we still want proximity to things. Also, what influences demand is jobs like the Olympics and things like that, and infrastructure, population growth. So if we want to focus on high growth locations, we want to track the historical performance. How do we do that? Again, we can use a software like RP Data, which shows the median or the average price of properties in a suburb over the last 20, 30 years. So for example, I wanted to take the 10-year average annual growth rate of a suburb to see what's the performance like. The way I can calculate that is I can take, let's say I wanted to have a 10-year average from 2014 to 2024. We'll go the current value. So what's the median value of a property in today's market? Subtract that from 2014. So let's say it was $1,500,000. The difference is 500,000. We then take 500,000 and divide it by the historical data, which was 500,000, which is about 100%. So that location has gone up 100%. And then if we divide that by 10, it's had 10% average annual growth rate. Let me confirm that math is right.
Yeah, I love it when you start mathing.
It's 10 times 10. Yeah, 10%. Yeah. So that's how you can track the historical performance of an average annual growth rate. Now, with that number, in Australia, on average for an investment, we want to be targeting suburbs that have between a 7 to 10% average annual growth rate. Yeah. Anything more is fantastic. In Australia, as a total economy and as an aggregate, it's about 6.5 to 6.8% is what we generally see. Yeah. So if we can achieve over that, fantastic. The other thing too, we want to look before COVID's boom. So from 2010 to 2020, I want to see what the growth rate was like prior to COVID. Marketplaces like Brisbane and WA, like Perth, have really poor levels of average annual growth rate before COVID.
Right.
But the last 10 years, including COVID, it's very strong. So demand for those marketplaces has increased over the last 6 years. But prior to that, the demand factor wasn't as strong as, say, New South Wales or Melbourne.
And do you hold more weight in those time periods?
So for anyone buying, what that shows us is that there's less confidence in data that we should buy in somewhere like Perth. There's more confidence in data that we should buy in somewhere like New South Wales.
Yeah.
So if I was a gambler, if I was an investor, I would rather invest my money in New South Wales. If I was a gambler, I'd rather gamble in Perth.
Sure. Yeah.
But that's not to say that from a hotspot speculating, which is going to perform better over the next 5 or 10 years, then maybe if I look at what will create more growth moving forward, maybe Perth makes sense for a period of time. But if we look at the East Coast, the supply and demand factors, you just really can't compare.
Yeah.
But each price point's different. You might get massive growth in 2-3 years in, say, Perth, and then after that it might be flat or it may not grow. But in New South Wales, you may just get consistent average annual growth rate over a period of time. So how to summarize how I understand location growth rate is I always want to look at the historical performance. If there's not much historical performance, I want to look at, okay, what could cause future growth? And that is what's going to impact demand, what is going to impact supply, and again, sticking to areas that have lifestyle drivers, good amenities, CBDs, etc.